Nonetheless, we think our readers may derive some benefits from the broader consideration of the level of stock market at the time of the 1971, even if what we have to state will prove more interesting than practically useful, or more indicating than conclusion. There's a fine passage near the beginning of Aristotle Ethics that goes, "It is a mark of our educated mind to expect the amount of exactness which nature of particular subject admits. It is equally unreasonable to accept merely probable conclusion from a mathematician and to demand strict demonstration from an orator. The work of a financial analyst falls somewhere in the middle between a mathematician or the orator. In various times in 1971, the Dow Jones Industries average stood on 1992 level of November 1964 and was considered to be in previous edition. But the present statistical study we have decided to use the price level and the related data of Standard Poor Composition Index because it is more comprehensive and representative of the general market than the T-stock DJIA. We shall concentrate on comparison of the material near the 4 dates of the former edition, namely year ends of 1948, 1953, 1958, 1963, and plus 1968 for the current price level, and we shall take the convention figure of 100, which is registered under various times in 1971, nearly 1972, and saline data to set forth for our earning figures. We present both the last year showing the average of 3 current years for 1971 dividend. We use these last 12 months figures, the 1971 bond interest and wholesale prices to August 1971. 3 years price earning ratio of the market was lower in October 1971 and the year end 1963-1968 was the same as 1958 but much higher in the earlier years. But the long bull market is important indicator taken into it could not be constituted by the indicator the market was especially high in January 1972, but when the interest yield on high grade bonds is brought into the picture, the implication becomes much less favorable. The reader will note that our table that ratio of stock returns to bond returns has grown worse during the entire period. So the August 1961 figures were very less favorable to stocks by the creations than it is in previous year examination. When the dividend yield was compared with the bond yield, we find the range was completely reversed between 1940 and 1972. In the real stock yield twice much as bond, but a new bond yield twice as much as more than the stock. There was the data in relation to the Standard and Poor Composite Index of various markets. The calendar year 1948 and 68 plus the year 1971 earning ratio means the earning dividend per share percentage. Price in October 1917 equivalent to 900 of the DJIA 3 years average figures. Our final judgment is that the adverse change in the bond yield and stock yield ratio fully offset the better price earning ratio of 1971 based on the 3 year earning figures. Hence, we use the 1972 markets would tend to be same as 7 years ago. That has been unattractive one of the standard point of conservative instrument. They may apply the result of 1971 price range of DJI between 800 to 950. In terms of historical matters, say 1971 picture would still appears to be one of the irregular recovery. Like a bad setback and support 1960-1970. It is in the past recoveries has been assured as new stage of recruitment. Persistent bull market began 1949. This is an export to the Wall Street in general during 1971 after the terrible experiments suffered by the public buyers of low-grade consumer stock offering 1960 to 1970. Cycle it is too easier 1971. The another twirl of new issue mere go. Hence, a dependable sign of imminent dangers in the market is lacking. As it was to 1998-92 level of DJI In November 1964, consider our previous edition. Technical terms, the outlook would appear to favor another substantial rise of beyond 900 DJI level before the systemic serious setbacks or collapse, but we cannot leave the matter there. Perhaps we should to us early 1971 market discard the horror experience of less than a year before the disquieting sign. Can such the headlessness go unpunished? We think of an investment as unprepared of difficult times here, perhaps in forms of fairly quick replay of 1916 1970 decline, perhaps in forms of another bull market flexing to follow by more catastrophic collapse. What course to follow? Turn back to what we said to the last edition reproduced here. There is a view at the same price level at as 900 DJI early 1972 as it was late 1974. Commentary of Chapter 3 by Jason Thewing. It is nearly 50 years of experience in Wall Street. I have found that I know less and less about the stock market is going to do, but I know more and more about the investors what to do. Benjamin Graham. What can the stock market past tell us about the future? The Graham found that chapter 3 stocks generally goes up over multi-decade periods, but the course of seldom smooth and never predictable. Reconciliation yourself to the uncertainty can be troubling first, but I promised a bright hope at the end. Where you should stand depends on where you should sit. If you are in your working and saving year, you need to accumulating wealth. The falling stock market makes it easier for you to buy more shares at a lower price for longer, assuming stock to ultimately recover an early stretch of falling prices are function like rocket fuel to promote your wealth and assumes gold. If you are retired and no longer earning a salary, however, you are decumulating and margin decline can be disastrous unless you are able to rely on income from the bonds, real estate, pension, social security, or equivalent. You will have to pay your expenses by selling some of the stocks. If you happen to sell into the teeth of the bear market, you lock into the permanent losses, and the more the market goes down, the more stocks you will have to sell to generate constant stream of income. Stock is stock. The problem of stock is the whole word contains letter T. Take away it, and you have a shocks. If the stocks were shocks, people would view 20% drop in price not as a lock but as a instead of picking, people should be purchasing the stock shocks of 20% off. You don't feel sudden urge to get rid of this one. You already won. You check your shock drawer. You check your shock drawer to see if you need any. Young investors should learn to think stock like shock and stock. Shock, you buy them when you need them. Stock, you buy them when other people want them. You want a shock, you want to buy more when the price goes down. Stock, you want to buy more when the price goes up. You keep them shock, you keep them even if you have some holds. At stock, you sell them as soon as the price goes down. Shock, then you mend them and save them to use as racks. Stock, you don't want them again until the price goes back up. Cape Fear. If you could determine when a crash will strike, you should set a top and step aside into the safety of cash and buy back in the stock at the bottom. One measure has become a popular way to try making its prediction. It is indicated that in cyclic adjustment earning and earning of cap ratio divides the current price of S&P 500 index by the average earning over the past 10 years, adjusting both of the price and earning for inflation. It was devised by the Yale University finance professor Robert Schiller, partly inspired by the Benjamin Graham himself. Many market commenters argue that when CAPE is higher than average, future returns will be below average. to make initiative since the more it costs you buy stocks now, the less return you will like to earn later. At the higher than average cap has tended to be following the lower average return has been capture flow.